We've got more strong evidence today that Europe is falling back harder into recession and the US is not far behind it. Not only do we have data on both, you can also tell things aren't going well by the fact that central bankers feel they have to downplay their rate cuts and even outright lie about them. Europe was supposed to be moving into recovery in the second half of this year. Instead, there's only confirmation it's just not happening. This is why the ECB has already cut its rates and is worried that it may have to do more, as I said last week, maybe even accelerate the schedule. And it doesn't help that this year's renewed downturn comes with even more questions about the labor market than at any time since 2020. We've got Volkswagen, Intel, and a whole bunch of others. That's certainly the case in the US, where manufacturing has fallen to a 15-month low. And that same source also says that service providers have only been this pessimistic just one other time over the last 4 years. Both manufacturing and services businesses are saying they need to cut jobs, with American producers indicating the biggest potential job losses since June of 2020. Now, I'll keep pointing out this is exactly what markets told us was likely to happen. And both the US and Europe, where both steepening in each market has become decisive. We also have gold hitting a record high, and that is neither inflation nor stagflation risk, just the opposite. And even though copper has managed to rebound in the short run, with gold up, the copper to gold ratio remains only a fraction off its recent multi-year low in terrible historical company. Like treasuries, bonds, or swaps, the markets are not signaling anything but substantial weakening and downside risk. And that's exactly what the evidence keeps showing, including, no surprise, we knew this was coming, central bankers, and particularly those at the Fed, who are now trying to claim that last week's 50 basis point rate cut was no big deal. We'll circle back to Europe's grim results in just a moment, but let's start with officials who realize the situation is increasingly dangerous. That's why the European Central Bank is talking about accelerating their rate cuts. It's why the Federal Reserve started out with 50. And both are now worried that those will be taken as confirmation, because they are confirmation, that the situation is increasingly dangerous. So we got the Fed, we've got the ECB, and policymakers, the Fed in particular, don't want you to read too much into that 50 basis point rate cut. Federal Reserve Governor Christopher Waller said favorable inflation data, not worries about the labor market, are what convinced him to support policymakers' decision to lower interest rates by 0.5 percentage point this week. Quote, "What's got me a little more concerned is inflation running softer than I thought," Waller said Friday in an interview on CNBC. And this directly contradicts exactly what he said just 2 weeks before on September 6th. Waller is outright lying to your face, counting on the public to not know what he said just a couple weeks before on September 6th. And what he said on September 6th was, "The balance of risks has shifted toward the employment side of our dual mandate. Policy needs to adjust accordingly. The current batch of data no longer requires patience, it requires action." So he says employment data requires action. On September 6th, the Fed cuts by 50 basis points, confirming they're concerned about employment. And then on September 20th, Waller, the same guy, says, "No, I was more enthralled by the fact that consumer price rates have come down faster than we anticipated." He's outright lying to your face here. And they're doing so because of very transparent reasons. Same thing that Powell did at his press conference on Wednesday. They cut by 50 basis points because they are legitimately worried about the labor market and the economy overall, as they should be, because that's what the evidence continues to show. But also realizing that because they cut by 50, that's taken as confirmation for what we're all seeing. They have to try to walk it back, or at least downplay the significance, so that you don't start panicking, as if the Federal Reserve just said you should start panicking. So there's this two-step that central bankers and officials always go through in rate cut cycles. They start out with major concerns. It's what they do, not what they say. And then what they have to say is that, "Oh, it was no big deal. Don't worry all about it. We've got it all covered anyway." Waller wasn't the only one. Neel Kashkari from Minneapolis Fed. Back on May 28th in London, he said, "I don't think anybody has totally taken rate increases off the table. I think the odds of us raising rates are quite low, but I don't want to take anything off the table. I want to get all the data I can get before the next FOMC meeting, which is July, before I reach any conclusions. But I can tell you this," Kashkari said, "it certainly won't be more than 2 rate cuts." So he says at the end of May, it won't be more than 2 rate cuts. And the Fed starts out in September with a double rate cut and projections for more, including projections from Kashkari. But today he says, you know what? It's not that big of a deal. Even though we've completely changed our mind here, it's actually not all that much. Today he said, after 50 basis points, we're still in a net tight position, so I was comfortable taking a larger first step, directly contradicting what he said at the end of May. As we go forward, I expect on balance, we'll probably take smaller steps unless the data changes materially. So it was just, we were way too restrictive, so we brought our policy rate back down, when back in May he said we needed to be too restrictive because the economy is too hot, it needs to be slowed down, assuming that Fed rate hikes anyway actually do slow down the economy. You kind of get the sense that they're just twisting with the wind here. Whichever way the wind blows, that's whichever way the Fed and its policies will change. Because that's exactly what happens. The Fed is simply along for the ride like everyone else. Finally, Atlanta's Raphael Bostic. Bostic is another inflation hawk on the FOMC who suddenly changed his tune, but then today says, no, I didn't actually change my tune. I'm just evolving with the data. Back on August 23rd at Jackson Hole, Bostic said, inflation has moved a lot faster than I anticipated, and that the labor market has had a, quote, big change with unemployment rate rising, though, he said, it's still solid. And then today, downplaying the significance of the rate cut, Bostic said, for sure, the labor market is not yet flashing red for me. And I want to be clear that I do not believe that labor markets are dangerously weakened. That is not what the data show, nor what business leaders tell us. But I also recognize that employment growth over the past year has not been as strong as initial data releases suggested. Any further evidence of material weakening in the labor market over the next month or so will definitely change my view on how aggressive policy adjustment needs to be. And of course, he just said this last month. He said, look, if the data changes, I'll be all in favor of rate cuts. Now he says, okay, well, if the data changes again, I'll be in favor of more rate cuts. But everything is just fine right now. Don't read too much into what we're doing. They all know that the U.S. economy is in big time trouble. In fact, one central banker, who's not an American central banker, last week admitted as much. The Bank of Japan, Kazuo Ueda, at his press conference when the Bank of Japan did not raise rates, sounded increasingly dovish, came out with forecasts for consumer prices that did not change. Why? All of that because, as Ueda said, we're worried about the U.S. economy. So the U.S. economy is so weak that it is having an impact, a direct impact, on Japanese central bank interest rate policies. At the same time, the Federal Reserve, which did a 50 basis point rate cut, tells you it's no big deal. They all know it's a big deal. They just want to pretend it's not, so that nobody gets too upset, nobody gets too panicky over the way in which the economy has evolved and how quickly perceptions have changed at the public level as well as the official level, and in some cases market changes over the last little while. In fact, it hasn't been all that long. And I just wrote about Ueda and his press conference and what's going on with the Bank of Japan and what they see about the U.S. from the Japanese perspective at our deep dive analysis on Friday. We dove deep into what Ueda had to say about his fears over the U.S. economy and how much that has actually dictated the Japanese stance. There's lots more over there that we don't cover here on YouTube, and in the deep dive analysis, we get to go much deeper than we do here. Eurodollar University also has memberships available where we get into the background behind all this crazy stuff. What is money? What are curves? In fact, I'm just finishing up our first video, the next segment in our basics series, which is going to be all about interest rate swaps. So information on all of our subscriptions and memberships, the daily deep dive analysis, the daily briefing at our website, eurodollar.university. Now to the data from today, S&P Global and its PMIs. I'll get to the European ones in just a second. Let's focus again on the United States. The U.S. manufacturing PMI unexpectedly fell to a 15-month low. That PMI, according to S&P Global, down to 47. But that's just consistent with all the other soft sentiment surveys that we've been getting from the ISM and the Fed regional surveys and everything else. S&P Global is basically confirming that the manufacturing sector, goods sector, has rolled over and is like Europe's overall economy, getting materially weaker, though this time, also like Europe, The danger here is more about employment than it is specifically about production volumes and things like that, backlogs and orders. Backlogs and orders have sunk so much and for so long, and with outlooks deteriorating, businesses are telling S&P Global and other surveyors that they can't hang on any longer. It's time to start thinking about letting go some of their workers. They've already cut back on hiring. They've already cut back on everything else. According to S&P Global, the orders index for the manufacturing fell at its sharpest rate for 21 months. And backlogs, which rose slightly for service providers, fell sharply and at the fastest rate for 9 months in the factory sector. And the net result was, according to S&P Global's press release, employment fell for a second month running in September and has now fallen in 4 of the past 6 months. That said, the overall decline was only very modest. I always have to paint it in the most positive light, and less than reported in August amid reduced job losses in the services economy, as if that makes any difference. The decline in service jobs was often linked to difficulties replacing leavers. They keep talking about a labor shortage, though the addition of new staff was curbed by uncertainty about the outlook. There's your hiring freeze on the services side. And manufacturing payrolls, meanwhile, were cut at a pace not recorded since June of 2020. So more and more indications that manufacturing job losses, some initial job losses, at the very least a hiring freeze on both sides of the economy as the numbers look increasingly grim all again. And I should note that S&P's services PMI, which is up in the 55 range, is a clear outlier among all of the services numbers that we have, especially compared to ISM and the regional Fed surveys, which look nothing like S&P Global. And the details behind S&P Global's PMI don't really corroborate the overall PMI number anyway. And that includes the outlook. Again, back to S&P Global's press release, optimism about output in the year ahead deteriorated sharply. The survey's future output index falling to its lowest since October 2022, and the second lowest seen this side of the pandemic. The deterioration in confidence was led by the service sector, amid concerns over the outlook for the economy and demand, often linked to uncertainty regarding the presidential election. And that last part they always throw in there because they have to have a narrative. They can't say the economy is heading toward recession, so they say, it's uncertainty linked to the presidential election. Or before they used to say, it's uncertainty linked to high interest rates or central bank policies or some other excuse. When the reality is the economy is simply getting worse, and service providers, whatever they're doing today, they're starting to realize that there's no pickup down the road. In fact, everything is pointing lower, including employment on both sides, manufacturing as well as service providers. At the very least, it's a hiring freeze, but more and more we're starting to see indications of layoffs. But as bad as the U.S. is performing, it's even worse in Europe. And it has been for the last couple of years. But Europe looked like it was potentially escaping the recession that's been stuck in, the unofficial recession it's been stuck in for almost 2 years. Earlier in 2024, there were some positives, especially in sentiment, with the prospect of rate cuts. At least that was the narrative. There's a seasonal upswing that we go through every year in the springtime. Whatever the case, it looked like maybe Europe was finally going to be able to stabilize and start recovering. But as has been the case over the last couple years, you get to the middle part of the year and then summertime is the time for recession. It all goes to hell all over again. And that's certainly the case in S&P Global's PMIs. Not just those for September here that we're getting, but also for the last couple of months have been increasingly negative. The fall in output was the first in 7 months and was registered amid a sustained reduction in new orders. In fact, new business decreased at the sharpest pace since January. With new orders and volumes of outstanding business falling at sharper rates and business confidence at a 10-month low, companies scaled back their workforce numbers for the second month running. Meanwhile, demand weakness resulted in slower inflation of both input costs and output prices. Steeper reductions in new orders and backlogs of work, plus waning confidence in the outlook, led companies to reduce employment again in September, the second month running in which this has been the case. Although modest, the drop in staffing levels was the sharpest since December 2020. Manufacturing workforce numbers were scaled back to the greatest extent in just over 4 years, same as in the U.S. PMIs. Meanwhile, services employment continued to rise, but at the slowest pace since August 2023. And against that economic backdrop where we have the U.S. economy looking increasingly recessionary, especially the labor market, the European economy, which has been stuck in recession and struggling to get out, now looking like it's going to get even worse, of course, gold prices are hitting a record high, another record high just today, well above $2,600 to an ounce. And this is not inflation risk. This is risk all over the world, from Germany, which that economy there just looks increasingly ugly, Europe as a whole, and obviously China. Let's not forget China, where things only continue to get worse there, especially as banks retrench. The real estate problem continues to be a major problem and a growing problem there. So gold continues to rise, not because investors and markets are worried about consumer prices being reignited by a red-hot economy or something else or government interference. Gold is going up as a hedge against the deflationary consequences of the entire world globally synchronizing into a recession. That's why the copper to gold ratio, even though copper has enjoyed a little bit of a short run rebound, the copper to gold ratio is just barely above its multi-year low set back a couple weeks ago, and it's down in the same territory as 2020, 2016, and late 2008, early 2009, the Great Not Recession. So terrible historical company, which a couple months ago might have seemed like really unlikely, if not outlandish. Suddenly, even central bankers are not only cutting their interest rates, they're completely downplaying them, if not outright lying about them, because they know how serious the situation has become. So we've got central bankers who are downplaying their own rate cutting cycle because that's what they do in every rate cutting cycle. They don't want to alarm people because they are alarmed. That's why they're cutting rates. And increasingly, the data that comes in from all over the economy, the latest here, the sentiment surveys, the PMIs from S&P Global, show that both the US as well as Europe, nothing good is going on in either place. In fact, more and more we're hearing outlooks deteriorating, which is consistent with the marketplace, as well as, most important of all, businesses all over both economies have been hanging in for so long, waiting for something to materially pick up. Meanwhile, backlogs have been dropping, sales have been dropping, holding on to workers, hoping beyond hope that something's going to work somewhere, with outlooks deteriorating, with backlogs almost gone, and with new orders continuing to contract. They're talking about laying off workers. They've stopped hiring, which gets you into the recession territory, and layoffs, which basically confirm the worst part of it. That's the implications that we get from all across these various data sources, up to and including central banks who are lying about their rate cuts. What happens in the stock market after central banks start cutting their policy rates? Well, contrary to popular perception, it's not rate cuts that stocks actually love. And I went over the data there in the video link below. As always, thank you very much for joining me. Thank you to Eurodollar University members and subscribers. And if you want to become one, check out both of those at our website. And until next time, take care.